Richard Jerram is Chief Economist at Bank of Singapore. Richard, thanks for coming in. We had that CPI number, of course, earlier, pretty much bang in line what economists thinking here. Are they concerned about inflation anymore? Because it does seem to be ratcheting down, and do the authorities there now concentrate on growth?
Yeah, it seems fairly clear the priorities are shifting. Inflation 6 months ago was running 6.5%. Now it's down to 4%. It's clearly decelerating. So I think what you're seeing is the whole policy focus is shifting to loosening monetary policy, letting growth probably head for a soft landing. So things seem to be working out remarkably well, I think, for China over the past 6 months.
Okay, so, what is the biggest headwind now? I mean, many people are talking about the property side of things, that the government should be just easing some of the restrictions here. Otherwise, we're going to see the property market just tank.
Yeah, I think there's two things we worry about. One is the property market, obviously, because you're not quite sure how much pain they're prepared to impose before they start to ease up on the specific housing-related policies. That's maybe going to be another 6 months, so you perhaps have reserve requirement cuts first, then property measures ease. We're also a bit worried about protectionism, because it looks as if the pace of renminbi appreciation against the dollar is going to slow down quite a lot as inflation comes off. Election year in America, to me it suggests you could get a bit of trouble through the year on that front.
Yeah, well, that could be one source of it. We've had, of course, Tim Geithner, he's in Turkey now, he's in Beijing yesterday and the day before, trying to talk up the RMB. They're trying to get them to do a bit more. Now, what do you make of his comments also this morning in Turkey, saying that he does see strength for the US economy? We've seen the data get better, but he's got to talk things up a little bit, hasn't he?
Yeah, it's an election year. Obviously, you want to promote a positive view on the economy. But I think he's right. And, of course, if you think about it, the European economy has been really struggling in the past 6 months. And despite that, the US economic data has been surprising on the upside. Looks like the housing market is beginning to turn around. Quite positive comments from the president of one of the home builders overnight on his results. So it does look to us as if there's more of a backbone to US growth than perhaps people have appreciated in recent months.
So do you think there's a bit more decoupling taking place from Europe as far as the US goes?
It certainly looks that way. If Europe's decelerating and America's accelerating, then that's about the best definition of decoupling you can have, I suppose.
Well, I mean, that is the biggest source of instability, though, Europe, isn't it, out there, as it was in 2011. And, the more we hear from them, the more jittery the markets get.
Yeah, I think for the Asian economies, you can see that the exports into Europe have softened a lot in the past 3 to 6 months, which isn't surprising when you look at the economic data, because the real worry is whether the financial system problems spread across to Asia in any sort of meaningful fashion.
No, they have already, haven't they, with banks deleveraging there in Europe, and then, of course, that money being sucked away from this part of the world.
Well, I think that was a factor in September in particular when you had that shock from the deleveraging. But I think in general, you're not seeing a big tightening of credit conditions facing the corporate sector because of the problems in Europe. So it looks to us as if you've got a moderate drag because of the growth slowdown without it being financial sort of shock in a Lehman type of sense.
No, that was just so sudden. This is a car crash in slow motion, isn't it?
Well, I don't think so, because I think you have the ECB in there, if you like, applying the, well, not applying the brakes, that's the wrong analogy, but providing the liquidity to make sure there isn't going to be a car crash. And they had a massive fund injection in December.
They certainly did, but it doesn't seem to have found itself into the system, has it?
Yeah. Well, it's early days. I think banks quite reasonably, first of all, they just put the money back on deposit. So first of all, it tells you the system's going to be solid because you've got a lender of last resort. And then the next question is, they're being offered, I think, a free lunch by the ECB. How long is it before they're prepared to sit down at the table and participate? And I would guess as the months go by, they'll gradually push that money into the sovereign debt.
Now, Richard, I know you're not an equity strategist, but when we look at what's been going on market-wise, of course, it's just after New Year, before the Chinese New Year, so people aren't really going to be properly at their desks until probably the end of the month. But what are we pricing in?
Well, I think it's interesting because clearly the markets look quite cheap by a lot of metrics. I mean, we're saying you want to be invested, but you don't want to be too aggressive because of the volatility that comes out of the long list of tail risks out there. And I think in the sense, we're quite optimistic on China. Our equity guys like China because of the policy cycle. They're saying you want to anticipate the policy cycle that's going to be basically giving you a tailwind for the next 6 months, and you want to be trying to ride that cycle by investing in the Chinese market.
Richard, thank you so much for coming in. Richard Jerram there from Bank of Singapore.